I'm Matt Bishar with REIT.com here in La Quinta, California for REITWise 2013, NAREIT's Law, Accounting, and Finance Conference. Joining me today is Luke Zubrod, Director of Derivatives Regulatory Advisory Services with Chatham Financial. Luke, thanks for joining us.
Thanks, Matt.
Chatham Financial recently released its 2013 REIT Capital Survey. What stood out to you regarding how listed REITs are funding themselves and managing resulting risk exposures?
Well, I left our REIT team about 4 years ago. I used to lead our team that worked with REITs in helping to establish hedging strategies and implement them. And since that time, I've been focused on derivatives regulatory reform issues. And the difference between the REIT market at that time and the REIT market today couldn't be starker. At that time, you had probably the keywords being defense and deleverage. And today, the story is one of overwhelming health. For the first time in 4 years, we had 22% of respondents, and respondents made up 30 or 40% of the REIT market overall. We had 22% who plan to actually increase leverage this year. And so, by no means is that the dominant theme of REITs, but I think it's quite indicative of just how far we've come, that you have some who are saying, you know what, not only are we healthy, we can support more leverage. And I think that that speaks to an ability to transition from defense to offense. Another response was that 77% of respondents plan to increase dividends this year. So again, just another hallmark of health, that REITs are in a position to not only sort of keep them constant, but increase them. And then lastly, for those who are renewing their lines of credit this year, everyone expects, for the most part, to increase the size of their lines of credit, increase the term of the line of credit relative to what they've historically been able to achieve, to decrease or tighten borrowing spreads and achieve less restrictive covenants.
And what are the biggest risks and opportunities that you see right now in the current derivatives market?
NAREIT was among a constellation of organizations that really pursued vigorously an end-user exemption to new derivatives regulations that would otherwise have caused REITs to tie up lots of capital in margin accounts in order to manage their risk exposures. And since that time, there's been about a 2.5, almost 3 year period of regulatory rulemaking, and I think during that time, a lot of people have justifiably fallen asleep and are focused on other things. And I think they may be under the impression, many may be under the impression that end-user exemption, we're taken care of, we don't need to do anything. But in reality, the way the regulations have come out, REITs do have, along with other end users, a lot of compliance obligations that they need to be focused on in order to continue managing their risk. So I think that'll really be a significant theme that we see in derivatives and risk management in 2013. The other aspect is long-term interest rates. So I think the Fed and Chairman Bernanke have breathed some confidence into market participants around having interest rates really kind of remain low for some period of time. He's put out specific triggers with respect to unemployment and inflation, and we aren't yet near those triggers. But at the same time, I don't think the market has much confidence in that state of affairs persisting over the long term. And in this rate environment where you have a low rate environment, the question people are asking is, how can we take this good rate environment and carry it into a future period where that doesn't necessarily continue? And the derivatives market certainly has answers to those questions. So that's another theme I think we'll see people talk about in 2013 and probably beyond as well.
And what about mortgage REITs? Do you see application of the new interest rate swap futures for mortgage REITs?
We do, yeah. So mortgage REITs under Dodd-Frank are financial entities and are subject to new requirements to centrally clear their derivatives. One of the features of central clearing is that you have to fully collateralize the market value of your derivatives positions, but not only the market value, some initial margin amount or excess buffer of margin that you have to post against your derivatives. Mortgage REITs tend to look at that as a feature that is dilutive to returns. If I have to have money tied up in a margin account that I otherwise could invest at more productive returns, that's not ideal. And so we do anticipate and have already seen mortgage REIT clients looking at what are the alternatives? What are alternatives that could potentially lower that initial margin amount and still allow me to manage my risks? And then also, what are the trade-offs that I take on when I choose a product that provides those benefits? So I think certainly the swap futures will be among the alternatives that mortgage REITs will and are considering as they think about weighing the trade-offs between lowering margin and flexibility, which has long been a benefit of the over-the-counter derivatives market.
Luke, thank you so much for joining us today.
Certainly. Thank you, Matt.
For more on this and other REIT news and analysis, be sure to visit REIT.com.